Hello and welcome to episode 8 of Rapid Rundown, your one-stop shop for last week's most important market-moving news. And let's jump right in with the first topic, which is that the Federal Reserve of the US stepped in to support market liquidity, with its first action this week being that it cut its benchmark interest rate by 0.25% to 3.5 to 3.75%, which is the lowest in a few years. And this is the third rate cut of this year as the Federal Reserve responds to slower job growth or even a contracting job market some months and inflation that's not too high. And alongside the rate cut, the Federal Reserve launched a 40 billion US Treasury-buying program to support short-term market liquidity, and this is to relieve funding stress from banks. And these two actions lower borrowing costs and increase liquidity, but also show that the US economy may be experiencing more of a slowdown than expected. And the second topic of today is that US tech stocks fall as investors rotate away from mega cap stocks. So US tech stocks, especially the largest AI-focused ones, have come under pressure as their sky-high valuations are being reevaluated. And investors are shifting money away from this small group of dominant tech names to spreading it to other sectors in the market. And this reflects growing fear and caution around how much future growth is already priced into big tech stocks, with some of them having very high price to earnings ratios. And the third topic of today is the ECB, the European Central Bank, and how it has signaled that it has no urgency to cut rates. European government bond yields have moved higher after the European Central Bank has signaled that it may pause rate cuts for now. And ECB officials are signaling and arguing that prolonged ultra-low rates could be counterproductive, which is why they are now pausing rate cuts instead of further cutting rates. And higher bond yields are helping bank stocks, but put pressure on assets that are more rate sensitive, meaning that they profit from higher liquidity. Okay, and the fourth and final topic of today is that the Bank of Japan is expected to raise rates next week. So the Bank of Japan is expected to raise interest rates next week, potentially to their highest level in decades. The Bank of Japan is expected to raise interest rates from 0.5% to 0.75%, and a Reuters poll of economists show a alleged 90 or more than 90% chance of this happening, with the cited causes or reasons for that being underlying inflation and pressures on the yen. And higher Japanese rates should strengthen the yen and reduce the flow of so-called cheap money into global markets. Okay, and that was it for this week's episode of Rapid Rundown. I really hope you enjoyed. This was apparently a rate cut special episode. And if you're a professional investor interested in robust trading results, check out autotradelab.com. And otherwise, hit the like button, smash the subscribe button and the bell. And thank you so much for watching.